the other sectors. Plus, they have got a lot of larger equipment which they've brought in earlier from Europe, which tend to be higher in cost, so the yield might be lower. So those are my assumptions. But why ours is high is what I can tell you about. And on the second question, which with regards to RINL, we haven't faced any challenge till now. And if you look at it, for the first quarter, even our receivable days have gone down and they have come to 77 days. So on the financial health of RINL or their payment cycles or anything, we haven't seen any challenge. If anything, that might be more at a government level. But on the operation of the plant and the activity, we do not see any challenge there, at least as of now.
And with this, whatever little obstacle we are having with the new NDA government, I believe RINL also would be sort of looking at the expansion and other things.
Absolutely. That is what we hear. There was a visit by the steel minister also at the plant recently, and only positive discussions were there as per our best understanding. So we do not see any challenge happening there.
Yeah, they also have that OMDC company having their own iron ore subsidiary. So future looks bright for them as well as for us now. Hopefully.
Absolutely. Thank you.
Yeah. Thanks a lot.
Thank you. A reminder to the participants that you may press star and 1 to ask a question. The next question is from the line of Jehan Bada from Nirmal Bang. Please go ahead.
Yeah. Hi, Himanshu. Himanshu, my question is on raw material to sales percentage, which was last year at 8%. That has gone up to 13%. So I presume that is mainly to do with the steel logistics segment?
Thank you for the question, sir. So that is predominantly for our steel distribution segment. As I said, there was one particular order that we had to execute in Q1 with a slightly lower margin. So that is the only reason for the increase in raw material to sale, because otherwise in our other two segments, there is no involvement of raw materials per se.
Right. Okay. And my second question is on the EPC side. So we had indicated that we will be entering this space. Any developments and probably from which quarter can we expect revenue, and what are the likely EBITDA margins in this segment?
Yeah. So thank you on that question. So on the EPC front, we have veered away from the run-of-the-mill EPC projects because of the challenges that we have seen in those. And we have been actively working with our clients to win some specialized service contracts in the areas that we are already working. Our focus remains that we should be able to maintain the EBITDA margins of at least 20%. Only then it would make sense for us to be actively pursuing them. And thankfully enough, there have been growth opportunities elsewhere, which hasn't brought us any immediate pressure of just picking up any EPC project for the sake of top line. So we are biding our time there, and we are hopeful that in this financial year itself, we will have something fruitful, probably towards Q4, if not earlier than that.
Right. Thanks, Himanshu.
Thank you.
Thank you. The next question is a follow-up question from the line of Nirvana Laha from Badrinath Holdings. Please go ahead.
Hi, thanks again for the opportunity. Could you explain what is the difference between gross and net yield, as in like what all costs are removed from the gross yield to arrive at the net yield?
Yeah, so the gross yield is basically outright rental and the cost of the equipment, and the net yield would be the operating cost that is part of the the operating crew that handles that equipment, the maintenance cost that goes into it, the insurance and taxes and other administrative charges that go into it. So that's predominantly what we do not factor into when we consider the net yield.
Okay. So basically what you're saying is that at the EBITDA level, if I see the segment A, whatever you're reporting at the EBITDA is basically the net yield, whatever you're reporting as revenue is basically the gross yield.
Yes, that's correct. That would be it.
Okay. So by that logic, because you said that net yield is 2% and gross is 3%, shouldn't the EBITDA margin theoretically be able to go up to like 60-65% in this atmosphere?
They could eventually reach that if everything was aligned with achieving 90% occupancy and we maintaining the occupancy at that level would only be possible if the equipment was deployed across the client projects for longer durations. But what happens is after, when we say 6 months contracts, there is a period of idling because of the movement of the machine to another project, which brings down the occupancy levels, and it also impacts the yield subsequently, because we're looking at, and this is a mix of equipment. So in our piling rigs, the yield, the rental, the gross yield could be higher, but the net yield is lower because of the higher maintenance cost there, because there's a lot of ground activity that happens under the ground. So there's a lot of wear and tear there. Whereas in the case of cranes, it is lesser of the impact on the net yield, and the net yield and the gross yield could be pretty similar with not much of an impact, because there the maintenance costs are lower. So as a mix, it is difficult to give you an idea on that. But as I had stated in an earlier question, our target remains that we should be able to stabilize at about 55% for this segment going forward. And if there is an opportunity to go further up, we will definitely work on that.
Okay, got it. That's very clear. Last question from my side. So if I look at your gross assets, so last year you closed with around 300 crores. This year by December you would have 400 crores. So over the year you would operate with around 350 crores average gross assets. So is it possible, is it within the realms of possibility that you can actually do like a 125 crore kind of EBITDA number in segment A? Or due to capacity utilization, that is absolutely like off the table? That's not a number that can be done.
I'm sorry, I couldn't capture the second half of your question.
Yeah, sorry. So because you are operating with 350 crores of gross assets average for the year, and you're reporting around 3% gross yield, is it, so if I just multiply these numbers, you reach a revenue figure of around 125 crores for segment A. Now, is that figure just a theoretical figure which cannot be reached because of the capacity utilization? Or that is a 50% YOY growth basically in segment A? Or is that, if things pan out well over the next 3 quarters, is there a small possibility that that number could also happen?
On those lines, yes, theoretically, it is difficult to achieve that number because of the challenges that are there in project execution. But when we look at the year-on-year growth, we have considered an aggressive target of 30%, predominantly because of the high capex, and which in the first quarter itself, as you see, 34% we have seen. So we can anticipate that this segment can grow anywhere between 35 to 40% on a practical basis. So theoretically, yes, 50% growth as you're looking at could be possible, but it looks like a very outright chance for that to be done.
Got it, sir. Very clear. Great execution. Wish you all the best.
Thank you. Thanks a lot.
Thank you. Participants who wish to ask a question may please press star and 1 at this time. The next question is a follow-up question from the line of Rohan Mehta from FICOM Family Office. Please go ahead.
Hi, thank you so much for taking up the follow-up question. So, could you also explain why your other expenses and tax that has risen YOY? Any specific one-off or any reason for the same, sir?
So if you, sir, would look at it on the Y-on-Y basis, on a percentage basis, the absolute numbers might seem high or low if you look at those absolute numbers just, but if you look at a percentage of the total revenue, we haven't seen a major increase despite there being a dip in our warehousing and transportation segments revenue and profitability. Our costs on repair and maintenance or power and fuel, only power and fuel has slightly gone up. The other expenses also have been pretty much 15.3% in Q1 FY25 of the total revenue versus 17.9% in Q1 FY24. So we've seen certain reductions, and only a few areas there have been a slight addition on the cost front. So that has helped in maintaining that. On the tax expense side, that is basically a calculation based on the IT Act and the Companies Act. So it is a number as calculated across the board for depending on the applicability of tax. So that is not something I could comment on.
All right, sir. And just my final question. So, steel handled that has come down to about 1.62. metric ton. Any reason also on the steel processing and distribution revenue where we have seen that nearly double? So what I'm essentially trying to understand is, can you explain the mismatch happening here?
Right. So the revenue in the steel distribution is not attributable to this warehousing and transportation segment. So when we talk about the steel handled, that is predominantly and only from the segment B, which is warehousing and transportation segment. The segment C, which is steel distribution segment, we do not count any steel handling activity there to this number that we are giving out to maintain that exclusivity for that segment. Because this, as I specifically mentioned earlier also, is predominantly one-off that we have seen as a major increase in the steel processing segment, which will not be similar going forward.
Got it. So thank you so much.
Yeah, thank you.
Thank you. The next question is a follow-up question from the line of Aman Vishwakarma from Phillip Capital PCG. Please go ahead.
Yes, thank you for taking my question. So I think I had one question on the break-even of the equipment. So of course I understand that there's many equipments across segments, but if you were to put a broad number as to how long it takes for you to break even from your purchase, I mean, if you could put a number on that.
So thank you for the question, Mr. Aman. Usually, to give you a ballpark figure, it could be 5 to 6 years.
To break even, right? So is it on sales or like post the margins and post the cost, everything?
So basically, I would look at it to break even on the net output versus the cost of purchase.
Okay.
The net receipt versus the cost of purchase.
Okay, got it. And on the next part, right, so I just wanted to understand a broad vision for the company, right? Because if you look at the historical numbers also, what happens essentially is, at least what I can see is, we spend money and then we'll see a certain spike in the sales and then the sales flatline. And that has happened over at least 2 years, I could see broadly. So I mean, so the sales sort of flatline. So I mean, is there anything that we are looking wherein, we could consistently grow it, maybe go down value addition of some sorts, or, that would give us a steady growth of sales as opposed to these spikes, more or less?
Right. So that is the very reason, if you look at it from our warehousing and transportation segment, there it is not predominantly about keeping investing into new capex that will only lead to sales and growth. It is about more getting new orders and tenders, which enables us to improve our top lines and the bottom lines, provided there are no aberrations like the first quarter. So there we continue to add value by addition of efficient steel handling processes and methods, which we've done over the last couple of years. And we anticipate that will enable us to further add value on the financial side as well. On the equipment rental segment, because it is capex driven, a lot of the revenue drive would happen with capex, but to further complement it, we are working on those value addition service, specialized service contracts, which is the area where we see that going forward, once we are able to align ourselves to it, the revenue growth would also be from that segment. So it will help us ensure that there is a consistent growth rather than any stagnation happening in the future.
Okay. And secondly, on the equipment, right, I believe your depreciation policy is in the range of that, the useful life of these equipments are in the range of 15 to 20 years.
Yes,
so would it not make sense for you to run these beyond the 10 years by giving it proper maintenance and maybe squeezing out a little more revenue from them?
No. So the way we see it is from the customer's perspective, because the machines will be able to generate good revenue depending on their being placed on customer sites for generating that revenue. So customer likability is younger equipment. So we churn the equipment based on the customer's demand cycle. So that is how we have kept a policy of 9 to 10 years. And there are certain equipment which tend to run up to 12, 13 years as well, if we see that there is a good opportunity and the condition of the equipment is such where the client is happy with it as well.
Okay, so is it fair to assume we could at least salvage 5 or 10% of the equipment value by the end of its useful life?
See, the way I see it, at the end of 10 years, we are able to salvage, going by the current trends, where we usually salvage about 50% of the initial purchase. So at the end of the complete useful life, yes, 20% or so is the salvageable value, for sure, if not more.
And just to follow up on that, I mean, who's the counterparty here? I mean, in these
So
purchases?
usually there are players who are entering, smaller players who do not have access to buy such large machines, new machines, because of the financial constraints. Two, there are also the original equipment manufacturers who buy back machines because of our consistent new buying from them. So there are buyback deals. And then there are opportunities to sell them out to other countries who are currently in the developing stage.
Okay, lovely. And just one last question on the capacity utilization. So if you could, I mean, I understand there's seasonality, there's the equipment moving, but regardless of that, I mean, what has been our capacity utilization for this quarter in both the segments, the equipment handling, rental and the steel handling?
So in the equipment rental, we had about 82%. In the steel handling, we do not really do a capacity utilization because there it is not based on the number of the area of warehousing we have or anything like that, because it is more of the tonnage of steel that we handle, and not the economics are not based on the space utilization, right? So
what was the tonnage?
Tonnage was 1.62 million metric ton, which was lower than the previous financial year, which was 1.8 million metric tons. So that was, as I have stated earlier, because of challenge that we faced at Visakhapatnam.
Okay, no worries. So I mean, this for the 3 months, right? 1.8 million.
Right.
1.62.
Yes.
Okay, got it, sir. Thank you. That answers my question.
Thank you.
Thank you. A reminder to the participants that you may press star and 1 to ask a question. A reminder to the participants that you may press star and 1 to ask a question. As there are no further questions, I would now like to hand the conference to Mr. Himanshu Agarwal for closing comments.
Thank you once again, everybody, for joining the earnings call Q1 FY25 of Tara Chand Infralogistic Solutions Limited. And as we had all these questions, I hope we were able to answer to the best of my ability. And if you have any further questions, please do feel free to send them out on email to the concerned, and we'll try to get back to you. Thank you once again, and it was lovely talking to all of you.
Ladies and gentlemen, on behalf of Tara Chand Infralogistic Solutions Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.